Peter Eliades with you for the Stock Market Cycles weekend update for the week ending Friday, November 22nd. A lot of things going on, but first, let us take a few seconds to explain to you our schedule for the next week or so. We are going from California to Arizona to visit our new grandchild, Maximos Alexander Eliades. I'll be gone for about a week, starting from this coming Monday to a week away from that to the following Tuesday. So we'll be gone, in other words, for Thanksgiving too. I will bring my laptop with me, and the laptop I can do these videos. The quality won't be as good, but at least I'll be able to do some videos for you at a time that could be critically important. Today was day number 15. Anyway, let's get the schedule down. We'll be gone from Monday of next week to Tuesday of the following week. That doesn't mean we won't be doing updates. They may not be daily. Remember, next week it's Thanksgiving also. So we'll keep you very closely in touch with what's happening with Sign of the Bear. Today was day number 15 of Sign of the Bear. And that in and of itself is important, and I'll show you why. You're looking at one of the reasons on the screen right in front of you. What I've done is I've gone back 50 years. So we've had 15 consecutive days. We need at least 18 to get a Sign of the Bear, and that still doesn't give it. I think I've made it clear that 18 consecutive days by itself will not give us a Sign of the Bear. It's what it happens after that, and we'll make that very clear to you as we go along. Anyway, what I've shown here on this chart, and I hope to go through rather quickly, is every time there's been a streak of 15 days that has been broken, what happens after the streak of 15 days is broken. Remember, we're at 15 days now. Is it always a bearish resolution? Well, not always, but let me show you and you decide if it looks like it may be overwhelmingly, at least for the short term, a bearish situation. These are not signs of the bear, by the way. They're just the breaking of a 15-day consecutive streak to the downside. The break has to be to the downside. In other words, you get a reading below 0.65, not one above 1.95. Okay, so I'm not going to go through these in terms of itemizing them for you. I'm just going to show them to you. This first one, I'll tell you, beginning is December of 1968. This is when a streak of 15 consecutive days of churning, by our definition of a ratio greater than 0.65, lower than 1.95, the advanced decline ratio for the day. Okay, so just follow the arrows. You see 1, 2, you see an arrow towards the end of the screen. Let's go forward from there so you can see where that's given. This is where it occurred here. This is in 1971. There's another one here in July of 1972. There's another one here in, it looks like, October of 1972. Some of these are signs of the bear. We haven't distinguished them. We've just shown them to you. It's where 15-day streaks end. But I just wanted to give you a picture of it. So from this signal, I believe, in 1972, I don't think there's another signal for almost 20 years. But let's go forward and look for the red down arrows. Actually, here's one here in 1977. Pay attention to what happens after these red arrows. This is July 22nd of 77, a breaking of a 15-day streak. Here's another one here. This is December of 79. And that's the cutoff point I was looking at, I think, from that 79 happening. Another one does not happen until 1991, 12 years later. But look what happens. And this is a bullish time for the market. Look what's happening in 91. But look what happens right after the breaking of the 15 days. Sharp move to the downside. I want to show you these because The fact that we've had 15 days in and of itself can tend to be at least short-term bearish. There's a group here that aren't quite so bearish. You can see this was not. This was short-term down move. This was another short-term down move. These are at the end of 1993. This was a great one right here. It was not a sign of the bear, but look what happened. This is February of 94. That's a big decline you had right here. This is the next one, June of 1994, a good short-term decline. Let's go forward in time. These didn't yield much of anything on the downside, sideways for almost a month. This one here, sideways to down for a month and a little more. But notice that after none of them, we appear to see immediate moves to the upside. Here we go. December 5th of 96, little to the sideways movement here. Great short-term signal here, negative one in 97. This one took a while to unfold, but it was right near a top. That was this one was given in April of 98. Going forward again, wow, great one here. Look at this. This was not a sign of the bear, but it was July of 99. Fabulous. Breaking of the 15-day. Look what happened after it. Look what happened here. This is 2000. Breaking of the 15-day streak. Look what happened. Here's another one right after that. Breaking of the 15-day streak. Look what happened. Let's go forward from there. Okay, now remember, from 01, I told you this a day or two ago, from 2001 to the current time period, I think there was only one other occurrence of 15 consecutive days. Look at this. Nothing here. 01, 02, 03, 04, 05, 06. The next one we got was we got one in 2017, but we broke that streak to the upside, not to the downside, so I didn't count that one. And I think that may be all of them. In fact, I know that's all of them. So I wanted to show you that to give you an idea of just the fact that we've gone 15 consecutive days in that churning pattern in and of itself could be a potentially negative occurrence for the short term, whether we get the sign of the bear or not. We're still looking to get that sign of the bear. We need 3 more days, Monday, Tuesday, Wednesday of next week. If we have 3 consecutive days that continue the churning, no day greater than 195, no AD ratio lower than 0.65. If we get it through Wednesday of next week, the day before Thanksgiving, we will have our 18 consecutive days. Now, mind you, I've emphasized again, that does not give the sign of the bear, but I'm not going to go through the added requirements until or unless we get very close to that or actually see it happen. Okay, so what we should do now is do a review of our 40-week projections. And let's take a look at the daily bar charts. We haven't looked at that for a while. We've somehow stepped back from that because we haven't quite met that yet. Okay, this is a 96.8 to 110.6 offset. That's what the blue and the black lines are here. The red line, 96.8. The black line, 110.6. That's the equivalent of a 20-week offset for the S&P cash on a daily chart. And you can see what the projection has called for here. You've known this for quite a while now. 3158.63, 3331.11 is the upside of that projection, the highest side. So this is from the daily charts. But I have to tell you that if we look at the weekly charts, the weekly equivalents, where we simply do a 20-week offset and then take that projection plus or minus 10%, let's take a look at that right now so you can see what I'm talking about. Okay, weekly projections are right here. So if we click on this, we are inside at least the plus or minus 10% of the weekly projection box. The actual weekly projection, if you use just the 20-week offset, is right around 3,200. It looks like 3,198 and change here. But when you take the plus or minus 10%, which the original Hurst theory allowed for in terms of margin of error for projections, that takes you up to 31,1276. We reached that area last week. So in terms of a plus or minus 10% using the weekly charts, we are in the window. We have not fully met it. That would again be around this level. Or going back to the daily charts, you have the number from that too. So this is what we're looking at. Not too much more to tell you. I can't tell you what an exciting time this is in the market. There are so many things coming together for a potential very important, very major market top. A big part of that equation, for me at least, would be a sign of the bear, and we don't have that yet. We've been talking about it. We're in the process of potentially setting it up, but we do not have it yet. We should have more information next week. By Wednesday of next week, if the pattern continues, we will have met at least the minimum requirement for consecutive days. And then from that point, we look at what happens after that. That becomes very important in terms of getting the signal. That's it for now. We're going to talk to you at some point next week. We can't promise you when. We'll be doing it from our laptop computer from the Phoenix, Arizona area. All of you, please have a great weekend. Again, I know I say this every time, but it's important. Tell your friends about these updates, what's going on. If they're market aficionados, if they're fans of the stock market, tell them what a great job this fabulous projection software is doing that Stephen Sherman helped us put together. Hopefully, we're within a month or two now of being able to release this software. We will keep you posted on that. And I hope you get very excited about what this software can do. Bottom right of the screen, if you haven't subscribed yet, subscribe. Once you subscribe, click on the notification bell. If there are any surprise updates, or we may be doing some of those next week, you will be notified if you subscribe and click on the notification bell. That's it for now. Thanks so much for watching. We'll talk to you next week.